New all-time highs again today. When is this train going to run its course? When is it going to get to its station? We're going to talk about this trend. We're going to talk about how bullish we are in context of these technicals. We're going to talk about how do we manage our expectations when we're this strongly bullish, and what do we need to have before any kind of pullback begins? What do we need to be seeing, and how do we manage different signs of weakness? We're going to take a look at our one way to trade small on our trade idea of the day, but go for a pretty decent size return. So it's a way to be bullish, to be strongly bullish in the direction of this trend, but also not put a lot at risk in case this mature trend ends. So that's the types of trades that we need to be looking for. Trades that don't give us very much of a loss if things turn around, but give us still plenty of good reward potential. So let's go ahead and get started. Today is Thursday, January the 16th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator. Nice, good close again today, closing a new all-time record highs. Came really close to another cluster. Again, clusters at this point in time, when you're now over 3 months into an intermediate run, it's more signs of weakness. So we just have to keep that in mind. But we are what now? How many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days into this near-term run, which is the typical run 7 to 12. So this was a typical run. This is a typical near-term run. Obviously, we've only had this one little pullback right there. Is the only pullback that we've had between two really good rallies here to start off. What I believe, we didn't quite get the market sentiment line down here below 50, but I believe this is the beginning of a market sentiment rally. It is on everything else, but the S&P 500 in terms of risk appetite. So the markets continue to be bullish. They continue to grind our way higher. I know in our portfolio we continue to, we have directional trades that are just doing really well along with this trend. And that's how we just have to keep following the trend on this, knowing that at some point in time there will be some kind of pullback, and the more we go like this, and move this up here, the more we go like this, the deeper the pullback will be. I mean, here let's get those fans. First of all, you can see the fans, how far up above the fans we are. We're way up above that 38% Fibonacci fan. That's how far we've pulled away from it. But there's another thing I wanted to show you here. Here we go. So this chart is what I wanted to show, and that is the fact you can see now the S&P 500 is nearly 10% above the 200-day moving average. Just for some context, in the last 10 years, here's the last time that the PPO, the S&P got more than 10%, and this was in January of 18. A lot of people pointing to that period. The difference is we're just coming off the 200-day moving average here. Especially when you look at it when you do look at it on a logarithmic scale. Here we go. So doesn't look so bullish now, not even close, where we had been above the moving average for a whole year by the time we got to January 18. But that was the last time. We had a 10% drop coming off of that low point. We had a similar type move, not quite 10%, but we got this far up above the moving average coming off of it, similar to what we saw just right here. And then we ended up with this is a 4% zigzag, so we had less than a 4% decline, but you can see the volatility that came about. Here's another time we got a 10% or more above. It was on a 23% run off the moving average. We had a 6% decline there. Here's another one coming off the 200-day moving average, an 18% run, where we followed that up with a 10% decline. And then over here we had a 27% run, similar to what we saw in 18, with a 6% decline coming off of that. And then finally in 2010, a 15% run with an 8% decline. So you can see that there's been plenty of other times in the last 10 years, and all of them have led to 6 to 10% declines from being this bullish. So now, but it's not necessarily immediate either. It's been, over here it's been a few weeks above. So keep that in mind too. But just know that we'll more than likely get some kind of, even if it's just a 5% pullback. And remember that the Fibonacci retracement levels, this is a 5% pullback right to there, to the 38% Fibonacci level. That's a 5% pullback, or a little bit less than that actually. So that kind of gives you an idea of like, I mean, even if we don't go up any more, and we probably won't, we'll probably continue to grind our way higher because there's really no catalyst right now to spark any kind of selling. So, if there is ever a catalyst, when we get down to that level, that's the type, I mean, it's just a 38% retracement. It's very typical. Wouldn't even get into the Fibonacci retracement zone. You can see the 62% levels lining up with the old market sentiment high point now that we have, where we peaked. And then we pulled back on that market sentiment 23% retracement before bouncing on a new market sentiment run, the first intermediate rally of this market sentiment run. So you take a look at the Russell 2000, it broke out. It had been underperforming, but in the last 4 days it's really kind of taken off. And it's also broken out here, and you can see intermediate posture back to being strongly bullish. Near-term line strongly bullish as well, popping out. This is a new near-term run for the Russell 2000. That we didn't get on the S&P. That pullback brought the near-term line down because the previous rally didn't get up high enough, whereas on the S&P it did, and we didn't come down to the 50-day moving average. So a good little rally on the Russell, which again put that into context here. The Russell 2000 is still not up to its all-time high, so it's making a run to catch up to where all these other indexes have gone. But you can see the nice, good bullish intermediate run that it's on right now. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below this video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us that you want us to do the video again tomorrow. So a quick way to give us feedback on what you're thinking. If you don't like our videos, you don't have to click anything. Also, while you're down there, comment. What did you get out of our video today? We always love to hear what you're getting out of it. Join our website at marketscholars.com for free. There's a link up there in the top right corner of your screen. Click on that link to subscribe. Very easy way to do that. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching us on our website, I invite you to check out our live videos that we do every day at 3:30 Eastern Time. I take a look at all the trades that we've done in these videos. We manage them until we close them. We talk about them every time we do one of these live videos. These are part of our monthly plus subscription plan. So check that out. There's a link right there. You can get some more details. In that plan, you also get access to all 8 of our trading rooms. And you can see the calendar of when those are scheduled over here on the right. Engage with us on social media. There's click on this heart right there. It opens up this new window. You can like today's Market Outlook tweet there. It's kind of closing out on me because I've already liked it, I guess. Click on the thumbs up icon. That opens up your Facebook post. Again, the more you engage with us on these platforms, the more they will continue to promote our content to you. They only promote the content that you follow with the accounts that you engage with the most. So we try to make that really easy for you to do that here. All right, now let's get back to the charts and take a look at the long-term chart. Look at how the week is shaping up. And again, this is the PPO on a weekly chart. And look, you can see it's getting relatively high here at 6.22. In fact, if I edit this and put it at the new level, again, you can see it's just not too common for us to get this bullish, where this is measuring the 15 to 200-day moving averages. You can see a couple times, but you see even here in 13 and 14, it didn't lead to any kind of like major reversal. You see this part over here eventually did, but it took weeks for that to happen. Same thing over here. You can see this one kind of led to some slowdown in 04. So there's precedent for us to be this bullish, and there's precedent for us being this bullish and not producing significant declines. More just kind of a pause in the long-term trend before resumption. In this case, before resumption of a couple of years of bullishness. So it's taking off the log scale there, and did I take off yeah, I did. All right. So again, we're hardly parabolic here. In the least, but you also notice again 1 2 3 4 5 6 7 8 9 10 11 12 13 14 weeks, and it's typically 4 to 13, so we're past the stage of kind of the long end of the range. So I mean, it's mature. So look for signs of weakness, knowing that we won't sell off until there's a catalyst for us to sell off. And right now, this seems like the only imminent catalyst could be something pertaining maybe to earnings that could start pulling things down. If we take a look at the 3 green arrow chart here, you'll notice that we continue with 3 green arrows. In fact, if you take a look at the 2 line versions, like again, you have to converge for a while before the MACD breaks down below 0, and we're still at the highest. The MACD is at its highest levels here of this run, and the histogram, we're diverging right now. So the stochastic shows the buyers are still easily in control. They haven't started. There is divergences showing up, and you also see those divergences in other oscillators like the RSI and CCI. So there's definitely divergences, but nothing necessarily that says we're breaking down right now. Just again, just signs of maturity, signs of weakness that tell us to lower risk, but not necessarily to be bearish, right? If you're shorting this market right now, you know, if you're like, it's okay to have some smaller shorts, some smaller bearish trades. But if you're heavily bearish right now, thinking that we are so extremely overbought and we're euphoric and this market's going to tank, and we can converge. The MACD here can converge for a few weeks before it finally drops below 0. And we haven't even started to converge. We're still diverging. And the blue line is moving up still. It's got to turn down and then form lower highs generally before it finally crosses down below 0 there. So that just means that we can grind our way higher, right? There's an opportunity we might pull back with seasonality down to February expiration. We might get to the 38% Fibonacci retracement. We might get that intermediate pullback. But more likely, if you don't look at the seasonality, is that we just grind for a while. And we could potentially grind in the upward direction for a while before we finally, again, you got to break the 8-day moving average and start testing the 17-day. You got to test that before we even get to the 30-day. And usually crossing the 30-day is about the time that the 8 crosses below the 17, the MACD crosses below 0. So again, nowhere even close to that right now. All right, if you take a look at the intraday chart here, you can see that, look at the move. I mean, we gapped up higher. Now the question is that a runaway gap, a breakaway gap, or is it an exhaustion gap? There's not a whole lot of volume here. Let's take a look at the 3 green arrow chart again for SPY. You can see it's not a lot of volume, so I wouldn't necessarily qualify as an exhaustion gap. Or consolidation type gap. They get filled anyway, right? So you would consider it more, and you wouldn't consider it a breakaway gap or a runaway gap because we're not starting a bullish move. We've already been in one, and we're not breaking through a significant resistance level. So that suggests that more than likely there's going to come a time where we fill that in. So keep that in mind. I mean, look, there's very, very little volume, obviously resistance above us, but there's also very little volume support below us until we get back down into where the gap is, down to 327. And even there, I mean, we are very, very far above the last major volume node we have here at 323. So be wary. You can still put on bullish trades, as you'll see we do today, but just keep those position sizes small. Our position size for our class, again, we've already put the trade on in our Market Outlook live video before the market closed, but we position size small, as you'll see. For this, one of the reasons is because of this, because you know at some point in time, the intermediate line is going to pull back below 50. It's never gone above 50 and stayed above 50 forever. It's always come below 50. The question is if and when and how, and we don't want to be caught too bullish, too overexposed, too leveraged if it starts coming back down now, right, during this time. But we still have to ride the trend in case it does. In fact, we're at 331. The low is here at 319, so we're about 10 plus points, 10 and a half points away, or at least that's the width of this 4-week range. You can see the low point stuck over here. It's going to gradually move up to this 320 level here in a couple of days, a few days here. So it's still going to be about a 10-point range. And it can go about 16 and a half points before it gets stretched too far. We start worrying about the slowdown. So there's still some upside potential up to that 333, 334 area. And at that point, we start worrying about it being stretched a little too far to the upside, especially if there's very little volume support below us because we're going up so quickly, like we've been doing here the past few days. Let's take a look at the volume again and the trading range. The volume at 54 million below yesterday. The trading range, including the gap, so we closed at 328.19. The low today was at 329.45, so over a point, maybe a point and a quarter, and we had a point and a half. So we're looking at 2 3/4 points, so above average on the range, and a little bit below average on the volume. And put that in context, here is that 3/4 point, so it's kind of up in this area, bringing the ATR up, but still not even close to 1%, where 3.3 points is. And once you start getting over 3 days with a range over 3.3 points, then we start, then there's the concern, right? At that point, will probably be a down day, because that's generally the case, and that will be our first 1% down day that we've had in a while. I mean, it was back here was our last one that SPX has had, and you look at SPY, and you notice it didn't have a 1% down day. It didn't have a 1% down day there. So, its last 1% down day was all the way back here on October the 8th. We're going on, over 3 months without a 1% down day. So the first trading range that we get, even if it's not a down day, if we start getting ranges that are above 3.3 points, because that's 1%, with volume in the 90 to 100 million range, that's, even if it's just a doji pattern, or if it's not a huge down day, that's a sign that we're starting that pullback, because that's all intermediate pullbacks. All intermediate pullbacks have 1% moves. You can see here's an intermediate pullback. See the 1% declines, 1% declines, 1% declines. They all have them. Now, 1% decline doesn't mean that we have to have an intermediate pullback, as we saw here on SPX, but every intermediate pullback includes 1% declines, if not 2% declines. Let's take a look at the volatility chart. And you notice it's really flatlining along this 85%, which is the sweet spot of the bullish zone. So volatility, that's why we're going up every day, because we're just grinding our way. It's a beautiful move, and it's been nice and flat here. So we're not really bouncing up, obviously, but we're not falling either to extreme. So we're just kind of gradually moving and going sideways, and that's about as Pollyanna or picture perfect of a move you can get in volatility in order to maintain a steady bullish trend on like a near term, on even a near term basis. All right, so before we check out what's driving the price action today, just to summarize, the strong bullish trend, mature trend, but still strongly bullish, no signs of convergence, signs of weakness in terms of clusters that we've had, and almost one today, and near-term divergences, but those signs are just for reducing risk, not necessarily reversing our risk to the other side. The expectations of this bullish trend persisting, at least for another week or 2 or 3, as we eventually start to converge and buyers are less in control, then we start looking for when and how that intermediate decline will really get going in earnest, once the market itself gets some kind of catalyst that sparks some volatility in the market. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there popping out in the top right corner of your screen. Click on that link. You'd either agree or disagree. If you click disagree, comment down below on what you're seeing. And share with the rest of our community what you're seeing. That would suggest either you're a lot more bullish or a lot more bearish than I am right now. All right, now let's take a look at what's driving the price action today. And you can see the big winner today on a daily basis was the small cap and mid cap indexes. They were the biggest winners, along with growth stocks, crude oil. Risk appetite was on the run. On the other end of the spectrum, the VIX was down, long-term bonds were down, gold was down. So you can see the market was looking to take risk and taking risk in the kind of the riskier asset classes. EEM was down below, say, ACWI, which is a mixture of U.S. and international stocks. So a little bit of a laggard there. And the S&P was just barely above it, but it was lagging other U.S. indexes. So you can see over here, over the last 4 weeks, gold's actually been an outperformer, with the dollar being down as much as it's been, and crude oil's also been down. So there's a little bit of a discrepancy here, really pretty much from January the 6th, when the stocks have been gradually moving higher. You can also see emerging markets have been bullish. But during this time, crude oil's been down. It's been down quite a bit, actually. And gold has been flat while the dollar's been actually up. So it's not exactly the most. I mean, you can see small caps are lagging. It's not exactly the most bullish environment, and that's over the 4-week period. If I just look at over the past week, just the 1 week alone, you can see real estate small caps doing well. I mean, we're kind of pushing, but we're not getting that same participation in crude oil in terms of risk appetite. So if I take a look here at the crude oil chart, you can see how we've pulled back. We've got light pink shading and yellow line. Now we have dark pink shading. We still have a yellow line because it's still rising, but that's not the best looking chart there, especially on this January the 8th, where we had such a large range. The near-term line is making a little bit of a run to the upside after being really bearish. So we'll see. Obviously, this is the candle for today. The candle yesterday, we got a long lower shadow the day before, and we're closing above the high of that day. So we might start getting a little bit of some kind of reversal in crude oil to the upside, which would be good for bullish appetite. You can see we pulled back down into this support level where there's a lot of support here. So it's going to be hard for it to keep going down too much farther. When you look at its Ichimoku cloud, you can see it's still above the cloud, well below the blue line, but still above the cloud where there's some support. It lost its bullish trend as it's now kind of noisy here. So we'll see if it will now rebound and make its way back up to the upside, which is actually what we'd expect it to do. On the other hand, if you look at like the dollar index has been bullish. It's rallied with that drop in crude oil. The dollar's rallied, but I don't expect the dollar to go up. We had long upper shadows. We closed a couple days ago below the low of these high days. We're pretty noisy here too. We're not unable to really get going, but we are below the cloud, above the blue line. So this is a reversal pattern, a bearish reversal pattern. We're expecting more of a move to the downside. So you take a look at like the long-term view, especially for bond yields. You can see bond yields are rolling over too and unable to really gain some traction to the upside, which would be what you'd expect would happen if crude oil rallies. You'd expect yield to rally too as the market prices in higher inflation expectations by in this case purchasing commodities and selling long-term bonds and letting their yields rise. That typically coincides with a bullish market in terms of risk appetite. But it's not quite there yet. It's so bearish. It's still kind of grinding, from these really low PPO levels, and it's still pretty strongly negative at this -6 level. And again, wouldn't be surprising if we got a double bottom or even a slightly divergent low point, where we obviously wouldn't go below that. I mean, we were 20%. That was such a strong move, and put some context into how bearish that move was. We haven't been that bearish in 20 years. That was the most bearish we've been in 20 years on the yield. That's how far down. I mean, it was more bearish than this. But you notice over here, we got to the 200-day moving average, a little bit higher than where we are right now, and then diverged to a lower low, but a higher low in the PPO, and then that sparked a run on the S&P. Whereas these two lows didn't have a divergence. They just jumped off of this, especially this November 16. So I wouldn't be surprised if something similar to early 2012 occurs, where we diverge to potentially a lower low in the early part of summer of 2012. For comparison, on what the S&P looked like in the summer of 2012, we had a little bit of a decline, but we rallied for most of that. All the way into September is where we rallied on the S&P. It had a little bit of divergence itself, but you can see that was a pretty decent move to the upside, while the 10-year note was dropping in August into September to the downside. So, that's not the typical pattern, but they can move. Yields and bonds and stocks can move in the same direction, and yields can diverge. So if you look at, I don't know if I've got enough back history here on the dollar index, and let's get rid of fit the studies and log scale. If you take a look at this, you can see during that same summer of 2012, the dollar took off to the upside. So after potentially showing some weakness, sideways action heading. So we'll see if that ends up being the case here. If we reverse this little reversal pattern here, get back above the 50-day moving average with a green arrow, and start working our way back up with a bullish candle again. That's definitely something to keep an eye on. I don't expect a bullish move to come out of the dollar, but obviously anything can happen. So just kind of keep your eye on the dollar and whether or not we get the dark green shading and the green line to come with it, or if we stay kind of in this quasi bullish or bearish pattern here, where we are bullish but not bullish enough to change the trend, but bullish enough to sell from those peaks. Now let's take a look at the sector rotation. So we'll come here to the sector comparison chart, and again, just look at let's just take a look at the last week that was, and we'll go to a 10-minute chart. And you'll notice, again, the S&P is up 1.25%. Technology is up, communication services is up, but look at what else is up quite a bit, especially in the last couple of days, and that's real estate and utilities. So a little bit of a bounce higher as we continue to really move higher to all-time highs, mind you, being led by utilities and real estate. So that's a little telling in terms of what's leading the action. On the other end, not surprising that discretionary and energy are lagging, because they've been lagging this whole time. If I were to switch this, say, to like a 3-month chart, here, let's go to a 3-month chart, go back to where it was. You can see, energy is lagging, discretionary is lagging, real estate and utilities have been really lagging. So it's a little bit of an oversold bounce in those areas. That might be a little bit of a move into that direction early before any kind of intermediate weakness. On the other end of the spectrum, technology and healthcare, financials are 3 big winners. They continue to be 3 big winners. And communication services looks like, and industrials are trying to join the party, but they're kind of matching the market. And then not surprising with the dollar, kind of not dropping yet, to see energy and materials lagging. But it is a little surprising to see both staples and discretionary both lagging. The consumer stocks are really kind of struggling here during this rally, and it's been all kind of technology, and for that matter, healthcare oriented. All right, so one stock that's kind of healthcare oriented that's showing a really good chart today is Canopy Growth. Obviously, this has been in the news lately. It's had a nice little breakout pattern here, dark green shading, green line, so bullish pattern on the market forecast. If you take a look here, look at the weekly chart. Look at that candle. A little bit of an inverse head and shoulders pattern breaking out this week, getting a new bullish posture, the light green, and still don't have we still don't have the yellow line, much less a green line. Remember, reversal patterns start with light green shading and yellow lines before they turn around. Like here, the bearish reversal started with light pink shading and yellow line, light pink shading, yellow line, then it turns. So light green shading and the yellow line would be a bearish pattern, but would also precede any reversal. If you take a look at the 3 green arrow chart, and we'll look at on 2-line versions for this stock, you can see that obviously we're diverging away for the first time in a while. On the weekly basis, you can see we've been negative for quite a while, and we're finally breaking above the 17 and working our way up towards the 30-week moving average. Taking a look at the long-term chart, we are breaking above the 50-day moving average and starting to fill in that gap towards the 200, and working our way up from really, 22%. That's a big decline from the 50 to 200-day moving averages there. That moving average is starting to rise. But this is a chart that really jumps off the screen at you. That's the volume profile, and you can see we came down so fast from 45 down to about 25. We came down so fast that there is very little volume in these areas, and we can, that's a gap that can easily be filled pretty rapidly too, even though the volatility suggests we might only get to 35 here by April expiration. The volume profile suggests that we could probably get up to 45 by April expiration, because there's very, very little resistance holding you back to the top of that value area, especially considering that we've broken up above. We've had this inverse head and shoulders. We broke above the point of control, and we're starting to work our way up towards that gap. So a very, very strong move. If you take a look at its trend strength indicator with the Ichimoku cloud, you can see we're above the cloud now. We're starting a moderately strong bullish trend here. And then finally looking at the DMI, you can see that we are above 25 and below 20. In fact, we're below 10. That's how bullish we are. The negative directional index has fallen all the way down there. And we've got dark green shading, which means the ADX has climbed above 50 and we got the positive price action here. So very, very good development for it. In fact, it kind of started way back here, and now it's the ADX got above 20, and now it's above 25. And you can see it can get above and stay above 25 for a while because of the type of stock this is. You can have some pretty decent momentum, stay pretty bullish for a while. You can see here we went up from about 25 all the way up to 50, and another strong run here. So you can have decent runs, and the volume profile suggests that we could have a pretty decent run there as well, or now as well. In fact, if I were to come over here, this is on the daily chart, but if I were to come over to like January the 8th of 19, so let's go to the volume profile for January the 8th of 2019, right before that big run. So January the 8th of 2019, and we'll go back to January the 9th of 2018. So it made that run through the point of control and through that volume node. So if it can make that run through there, imagine the kind of run it can make without the volume resistance working its way through. So if I were to go now, say to August the 8th of 2019, so there's that run from January all the way through that point of control, that volume. Whoops, I'm sorry, that's on SPY. Let's go back. I should have noticed that earlier. January the 8th. Hit OK, and then let's look at CGC. There we go. So there, once it cleared this level, which it did on, what was it be? Let's go to the 10th, and we'll do this on the 11th. You can see how it cleared that gap, and then it just kept going from there. By the time we got to February the 10th of 2010, we had cleared all the way up to the top. And that's the type of move we expect to see right now. So to trade that, we came over here to the April options to give us plenty of time. We went below 40 in the delta, bought the call option. We did not use a stop order because we position size around the full maximum loss. So we've got, here, let's get rid of the, we've got the $600 at risk. So it's a small position to begin with. And of course, most likely won't take the full maximum loss because it's got to expire worthless for that to happen. So we'll probably end up taking about $300 most likely, even though we're position size for worst case scenario. But if it gets up to $45, we got about a $5,500 risk. So $300 of risk for, or reward, excuse me, $300 of risk for $5,500 of reward. That's a pretty decent reward to risk ratio if we end up getting a move like this, like we saw before. Alright, so that wraps us up for today. You've heard from me now. Now you want to hear from you. Use that link right there. It's popping out to go to our forums on marketscholars.com. Open up any new thread with any questions or comments that you want to keep the conversation going on. Let me know, and we can keep it going. You can reply to anybody else's threads as well. Remember, you have to subscribe to our site for free to be able to use that particular forum. All of our class forums are for our premium subscribers, but for that particular forum, it's available for all of our subscribers, premium, our monthly plus subscribers, as well as our free subscribers. I remember you can hit that thumbs up down below on our video, comment on our video, and subscribe to our YouTube channel. Follow me on Twitter for more content in between these videos, and join our community on our website, as well as the Facebook group that we've created for Market Outlook viewers. Again, have a great rest of your evening, everybody, and we'll see you all tomorrow.